Welcome to the 2026 season of the Municipal Securities Rulemaking Board's podcast. I'm your host, Tina Marchetti, Content Manager for MSRB. With me is John Bagley, Chief Market Structure Officer, who will walk us through some of the significant events that occurred in the municipal bond market in 2025. Before we get started, I wanted to note that much of this conversation is based on a new report John wrote with Marcela Vieira, Senior Director of Research and Market Transparency. The report recaps the major market developments in 2025 and compares 2025 to recent years. The report can be found in the Research and Data section of MSRB's website, and many of the statistics mentioned in this podcast are available in the Market Statistics section of the MF website. Also, John's comments are purely his own opinions on the municipal market and do not necessarily represent the view of MSRB or MSRB's board. John, to start this podcast, please give us one word you think would accurately describe the municipal securities market in 2025.
Really, since April last year, to me, there's only one word that describes the market: extraordinary. As we'll discuss later in more detail, this was a year for new records and other important developments in the market. Considering 2025, we saw a fourth consecutive year of record trade count, a second consecutive year of record new issue volume, a record year for the par amount traded in fixed-rate securities, record inflow into tax-exempt ETFs, and continued significant growth in separately managed accounts, also known as SMAs. The market has become quite dependent on this demand, and what else you saw in the marketplace was a dramatic increase in live quotes and bid want-ins on alternative trading systems, or ATSs, and finally a significantly larger presence of institutional investors on ATSs and in the trading of odd-lot securities. All these factors are consistent with a market that is becoming more and more electronic. As we ascertain in our year-end report, it appears there was a fundamental shift in the municipal market. The growth of the SMA business and ETFs, coupled with technological developments, seem to have fundamentally changed the marketplace.
Since your word for the year for 2025 was extraordinary, I think we will have to start with trading volumes. What did you see?
For 2025, any conversation about trading volume has to start with trade count. As I mentioned, 2025 was the fourth consecutive record year for the number of trades executed. Not only that, trade count was up dramatically, higher than any other year. Consider trade count was up 22% from 2024, the previous record high year. It was also up 35% from 2023. And if you look back to 2021, trade count more than doubled, up 130% from 2021. The unprecedented trade count was driven by strong demand from individual investors directly and through separately managed accounts. But I don't think these numbers alone show how extraordinary trade count has been in 2025. Consider the following. In 2024, then a record year for trade count, the market averaged just over 57,000 trades per day. In 2025, we averaged more than 70,000 trades per day. And there were only 15 days where the trade count was below the daily average of 2024. Only 15 days. Most of these days were also associated with closings related to holidays like the Friday after Thanksgiving. So just a dramatic increase in the day-to-day volume. Also in 2025, 7 of the last 9 months had more than 1.5 million trades. Prior to 2025, that only happened once in November of 2023. And also in 2025, the top 10 days for trade count of all time all happened last year. And we've been collecting data since 2005.
John, from 2018 to 2021, the market had 4 consecutive years of declining trade count, from just over 10 million in 2018 to 7.6 million, down 25% in 2021. In your mind, what are the primary factors that have led to this dramatic and extraordinary turnaround?
That's a great question, Tina. And there's obviously many factors, but if you're asking my opinion for the primary drivers of this unprecedented change, I would have to say 3 things. 1, the dramatic and sustained growth in demand from individual investors through separately managed accounts and not separately managed accounts. 2, and we mentioned this previously, the electronification of the municipal securities market. And 3, you cannot discount higher interest rates and the impact it has on demand.
Could you take us through these 3 factors, starting with demand from individual investors?
Sure. I would say that the separately managed accounts has been a major factor in the growth of trades, but you can't discount the non-separately managed accounts as well. Demand from individual investors has been key to driving the record growth, and they've become more and more important to the marketplace. And really, when I look at the municipal space, you cannot overemphasize how important individual investors are in this market, especially now. They hold almost half the outstanding municipal debt directly. In comparison, in the corporate bond market, individual investors only hold about 2% of the outstanding debt. Also, this demand from individual investors is happening at a time when banks and insurance companies have been reducing their holdings, and tax-exempt mutual funds have been seeing inflows, but very small inflows. It has been demand from the individual investors in SMA and non-SMA accounts that has been the driver for demand. One of my first bosses once told me one individual investor may not know much about the market, but collectively they know everything about the market, and that was definitely the case in 2025.
John, the second factor you mentioned was the electronification of the market. Could you elaborate on that?
The growth we have seen in this market would not be possible without technological advancements in the municipal market. Much of the SMA growth, which we've talked about, has been fueled by lower investment minimums. You used to need 1, 5, or even 10 million to open an SMA account. Now minimums can be as low as $250,000. Advancements in technology made this possible by allowing buy-side to manage significantly more accounts without increasing costs significantly. It also shows up in a dramatic increase in institutional investors trading odd lots of 100,000 or less. Quick promo, the MSRB research report that was published in February 2025 shows that it is highly, highly likely that more than half the customer trades of 100,000 or less were executed by institutional investors, often SMAs. Again, advancement in technology now make it cost efficient for institutions to trade non-lots. That was not the case 5 or 10 years ago. And finally, although we'll talk about this in more detail in a bit, the growth in trade count and par amount trading is nothing compared to the growth in live quotes and bid wanteds in the market. Again, better tools are vital for market participants to keep up with this growth.
You mentioned a third factor, and that was higher interest rates. Could you talk about that?
Yes, if we look back, people tend to have short memories, but if you go back prior to 2022, the market had seen an extended period of low interest rates, with interest rates reaching record lows in the summer of 2020. I remember back in that period of time, 10-year tax-exempt yields were right around 0.5%, and they remained between 1.5%, 1%, and 1% through the end of 2021. But in 2022, almost immediately, yields started to rise, and so did demand from individual investors, hence the dramatic increase in trade count. We mentioned prior that the growth in trade count from 25 from 24 was 22%. However, if you look at what happened in 2022, trade count rose 66% compared to 2021 because you saw yields rise for the first time in a long, long time, and that spurred demand from individual investors. Yields continued to rise through most of 23 and 24, and they peaked in April of 25. Previous MSRB research has showed trading volume, especially trade count, is highly, highly correlated with benchmark tax-exempt interest rates as well as volatility. And this is very evident when you look at where yields have been and where trading volumes have been over the last 5 years.
John, the stats you have mostly discussed so far reference the impressive increases in trade count, but that's just part of the story, isn't it? What about par amount traded? Are you seeing similar patterns?
That's a great question, Tina. Although we have seen significant increases in par amount trade, it is not grown nearly as the same level as trade count. For example, par amount of 2025 is up 14% from 2024 and up about 70% from 2021. Now, a 70% increase is nothing to overlook. However, trade count, as we said before, was up about 130% during that same period of time. So yes, growth in par amount traded as well, but no, not keeping pace with trade count.
Trade count increasing faster than the par amount traded must mean that the average trade size has declined. Can you discuss the changes in average trade size?
You can't argue with math, Tina. Yes, we have seen a consistent decrease in the average trade size over the last few years. For example, in 2021, average trade size was greater than 290,000. It was 229,000 in 2024, and dropped to about 214,000 last year. So continued trend towards lower average trade size has been seen for at least the last 5 years and probably longer than that.
What do you attribute that drop to?
To me, declining average trade size is consistent with a market that is becoming more electronic. As we mentioned earlier, there are more market participants willing to buy and sell odd lots because they have tools that make it cost-effective for them. Institutional investors and dealers are more likely to trade and trade more often than individual investors, so average trade size was bound to decline.
Besides record-setting trade volumes, we also saw record issuance in 2025. Could you discuss what happened in the primary market?
The primary market, again, so, as we mentioned prior, set a second consecutive record for new issue volume. Um, New issue volume for 2025 was $580 billion, which was up 20% from 2024, the previous record. And as we've seen in recent MSRB publications, when you compare 2025 to 2021, most cases the 2025 numbers are strikingly higher. However, that's not the case for new issue volume. Prior to 2024 and 2025, 2020 and 2021 were the highest years for issuance. However, they were driven by different factors.
How so? Could you expand upon that thought?
Yes, in 2020 and 2021, new issue volumes were dramatically aided by huge refunding volumes. As issuers took advantage of historically low rates to refund deals, they often issued taxable debt to refund tax-exempt debt. And if you go back, as a case in point, in 2020 and 2021, taxable volume was about 30% of the market in 2020 and 25% of the volume in 2021. In 2025, it was less than 6% of the market. So you got to go back, right, when you had this time of COVID and a lot of unknowns in the marketplace, but rates got so low, issuers were able to refund deals to create savings, which obviously helped them in a time when people didn't know what was going to happen from a revenue perspective. So they could use taxable issuance to refund deals. So the volume in 20 and 21 was driven by the taxable side, where the volume in 25 was driven by the tax-exempt side and the new money side. One other trend I would like to point out, there's been a significant drop in private placements in the marketplace. From 2020 to 2022, private placements ranged from about 5.5% to 8% of the overall issuance. In 2025, it was just a little more than 1.5%. So a dramatic decrease in the amount of private placements relative to the overall marketplace.
I want to go back to something you said earlier about live quotes and bid wanteds growing even more than trade volume. Could you explain that a little further?
Sure. The MSRB receives summary-level data from various alternative trading systems, and in 2025, the number of live quotes grew almost 30% from 2024 and almost 80% from 2023. If you compare it to 2021, the number of live quotes is likely more than tripled, and the number of bid wanteds has grown even more. Bid wanteds grew about 85% in 2025 from 2024, and the daily average number of bid wanteds compared to 2021 is likely 4 times higher.
What do you attribute those stunning increases to?
It's a common theme in this, but I believe it's because of electronification of the market. It has enabled both the dealers and investors to bid on more items, to offer more securities because they're incredibly more efficient than they used to be. And also, I think what has had a major impact is I believe institutional investors are significantly increasing their presence on ATSs.
And why do you think that is?
The data shows it. MSRB closely tracks activity on ATSs, and we have for years. And in the interdealer market, the percentage of trades that are executed on the ATSs has remained fairly steady, anywhere between 55 and 58% of all interdealer trades. However, when you look at customer trades executed with an ATS, that has risen significantly. In 2021, customer trades with ATSs was about 12% of all customer trades. In 2024, we saw that grow to 17%. And in 2025, it reached an all-time high of 21%, a significant increase. And if you look at 21%, that means that more than 1 in 5 customer trades in 2025 were executed on an ATS.
Earlier, you mentioned an MSRB report that shows a high correlation between yields and trading volume. What can you say about benchmark tax-exempt yields in 2025?
I think what you're seeing is historical benchmark tax-exempt yields show a huge spike in volatility in yields the week of April 7th. 10-year benchmark yields went from 293 on April 4th to 380 on the 9th, increasing more than 80 basis points in just 2 days. Rates peaked on April 9th, and that week was incredibly volatile the whole week, but volatility really dropped right after that. And from mid-April until the end of October, benchmark tax-exempt yields just steadily declined, more than erasing the 80 basis point rise we saw during those 3 days in April. However, because yields rose so quickly in the second quarter of the year, the average yield in 10 years in 2025 was higher than any recent year. And we know higher yields lead to higher trading volume. The other thing that was fascinating to me about the market is how little rates changed in the last 2+ months of the year. From late October through the end of the year, benchmark 10-year tax-exempt yields stayed within a 5 basis point band. I have a hard time remembering such a long period of time with little to no change in yield, and I've been doing this for 40 years.
So where did yields end up for the year relative to 2024?
It's an interesting dichotomy in the market, Tina. So benchmark tax-exempt yields were lower by 35 to 50 basis points for securities maturing within 10 years. However, the long end of the market actually saw rates rise. If you look at the 20 to 30-year sector, they rose by about 30 basis points on the year.
And what do you attribute this diversion to?
Well, I think there's a couple factors. One, the Fed easing certainly impacted the short-term market much more than the long-term market. So I think that helped rates ease in the short end of the market. But I don't think that's the only reason. I think a couple things had a major impact on the long end of the market. One, I think record new issue supply likely impacted the long end of the market much more than the short end of the market. Separately managed accounts do not tend to primarily focus on the very long end of the market. Historically, mutual funds have been a major player in the long end of the market, but we mentioned mutual funds had small net inflows, so they probably had X amount of demand for the marketplace, but there was a lot of volume that came through the 580 billion. So I think the 580 billion probably weighed on the long end of the market a little bit, and you saw it underperform the treasury market.
You mentioned small inflows for tax-exempt mutual funds. Overall, what can you say about institutional investors in 2025?
Tina, it's sort of a mixed bag. As we said previously, we saw great demand from individual investors and SMAs and non-SMAs. Also, tax-exempt ETFs had record inflows of about 45 billion, up more than 50% from the previous record in 2022. We mentioned mutual funds had small inflows, and inflows are good. They're certainly better than outflows we saw in 22 and 23, but they weren't dramatically large. And on the negative side, we continue to see banks and insurance companies reduce their holdings of municipal securities because of lower corporate tax rates. According to Federal Reserve Board data, through June, banks and insurance companies have collectively reduced their holdings by about 5%. Although these reductions in holding have been orderly, they obviously have impacted demand for tax-exempt bonds.
Is there anything else you want to say about investors?
Sure, Kina. Historically, tax-exempt market has had a narrower investor base than other fixed income securities because the tax exemption is not as valuable to some investors as it is to others. For example, the exemption does nothing for foreign investors, and the value of the tax exemption is limited for tax-deferred investors like pension funds. So historically, the market has relied on individual investors, mutual funds, banks, insurance companies, and ETFs. With lower corporate tax rates making taxable fixed income more attractive to banks and insurance companies, the tax-exempt investor base is even more narrow and heavily reliant on demand from individual investors.
Does that give you any concern?
No, not too much. However, I think it'll be interesting to see how demand from individual investors might change if rates decline significantly. Again, we've seen high correlation between demand and rates. So, that could be a challenge for the market if rates were to go down, and we'd have to see demand increase from a different sector of the marketplace, likely.
Thank you, John. That was a thorough review of 2025. What about 2026? Do you have any predictions for us?
I always have a couple, Tina. First of all, unless rates spike higher, I certainly expect new issue volume in 26 to exceed what it was in 2025, making it 3 straight years of record volume. I just feel the funding needs of state and local governments are growing, and so I expect them to come to market at a record pace. For trading volumes, I'm less certain, although I fully believe that the market will continue to become more electronic. We've really just seen an incredible increase over the last 5 years, and I get the feeling at some point the market might just take a rest and we could see some decline, not dramatic declines, but some. But again, I think as our research has shown, where the volumes are going to be are largely going to be impacted by what happens to interest rates. But whatever happens, we'll be watching, Tina, and I'm sure despite all my years in the marketplace, something's going to surprise me.
Thank you, John, for walking us through the key trends in the municipal bond market in 2025 and making some forecasts for 2026. And thank you, everyone, for listening to the latest MSRB podcast. The information provided in this MSRB podcast is intended for educational purposes only and provides a general overview of the subject matter. The content of the podcast does not constitute legal, investment, tax, business, or other advice, and is not an MSRB rule or an amendment to or interpretation of any MSRB rules. MSRB podcasts are the sole property of MSRB. You may access and download MSRB podcasts only for your educational, non-commercial use. You may not reproduce them in whole or in part, in any form, or reference them in any publication without MSRB's prior written consent. Copyright 2025, the Municipal Securities Rulemaking Board. All rights reserved.